Hey everyone, welcome to Composer's webinar with Enders Capital. I'm Michael, a product marketing manager at Composer, and I'll be your host for today. The thing we say here is investment advice. And we're thrilled to have Moody and Risley with us from Enders Capital. Welcome to the show, guys. Could you give us a brief intro of your background, maybe how Enders formed, and what drew you guys both to algo trading and eventually starting a hedge fund?
Yeah, thanks. We're really happy to be here. So, hello to everybody in the audience. Welcome. For me and Enders Capital, I think the journey began. I've always been really interested in trading, and it kind of goes back to where I think I started my career. Was working in finance in 2008 as an intern for a big hedge fund and brokerage firm, and it's probably the worst time to do it. So I learned a lot there, but at the end of the day, I felt like they were really a great online marketing company more than they were a hedge fund, and I actually ended up switching careers entirely and going into the marketing field. 15 years later, I ended up selling one of the biggest digital marketing agencies and got to walk away with some cash and became like an investor who got to dabble in a lot of different things. And I met, I had expensive dinners with all sorts of brokers and people who wanted to take my money and essentially put it in indexes and do things like that. And I ended up investing in a lot of different things: real estate, venture capital, and I even really got my hands dirty and flipped some houses into Airbnbs. I've done a lot. And at the end of the day, I just felt like I wanted something that wasn't necessarily correlated to everything else. And to me, trading was what I thought was going to be it, going long, short, that kind of thing. And finding algorithms about 2 years ago, that's when everything clicked for me as an investor, as a trader, and really is where I began. I think began putting all the pieces together in terms of building a foundation for my own money and building a portfolio that made sense. And so, fast forward, we learned a lot of things and we had a lot of interest from friends and family. And, I ended up trying a bunch of different things, not just Composer, but I was even getting my dad has a Composer account and he's up a bunch, and it's it was really funny. So I was okay, let's take this seriously. And I felt that, there was enough friends and family that wanted to be a part of what we were doing that we created a fund to do just that. I think that's pretty much touches on everything. I ended up meeting Risley along the way and a couple of our other partners, and together there's essentially 5 of us or so. We come up with different strategies, and a lot of it's on Composer, some of it's not. And, we think that we have a really good idea of how we want to build our portfolio with both Composer algos and non-Composer algos as well. And then, so Risley's one of my main partners here. Do you want to give an intro to you as well?
Sure. So I'm Riz. I have a very different story than Moody, where I'm at the very beginning of my career, essentially. So I actually am currently in residency, so I'm a resident physician in Pennsylvania. But along with the education that I've had for medicine and the degrees that I've gotten along the way, I've also been trading for probably about 8 years now, kind of on and off and to varying degrees. I'm primarily a derivatives trader for the Standard & Poor's 500, so I trade futures and options primarily. And it's been a lot of fun. It took a year or two for it to click, but all of my kind of background into trading and finance comes from the retail trading side, and I've developed a pretty diverse technical background along the way. So I ultimately, that's how me and Moody met. Actually, was in a trading community, and me and him clicked kind of right off the bat. And he's the one that ultimately introduced me to algos a couple of years ago. So it was interesting to take kind of my lens on things coming from the derivatives trading world, and then start to look at algos and start to work on those with Moody. And I think we've been working on them for, I don't know, it's been a couple of years now at least, but it's been a lot of fun.
Sweet. And with that in mind, I guess, Moody, like you mentioned, you run some of your algos on Composer. Do you mind sharing some insights to that and why you chose Composer to run some of your algos there? and maybe go into a bit more detail at how you guys approach, portfolio construction at Enders.
Yeah, no, so I'm going to try to give as much value as possible because I imagine people who are in the audience are using Composer to some degree or thinking about it, and I really love the platform. So here's what I think about Composer. So one is I think the landscape is changing for quants significantly, and I think like a lot of the industry, especially in finance and investing, they like to kind of put things behind closed doors or make things secret or make things sound a lot more complicated than they are, when really I think that Composer has simplified what's possible. And I think even today, I think 50 or 60% of all money is passive money in the markets, right? It's like sitting in indexes, mutual funds, that kind of thing. Or it's just in big, it's sitting in big buckets that just can't even be moved. Right, I think we're a small firm, so we can move money pretty quickly, and in Composer's sake, on a daily basis. But I'd say what's interesting is Composer is all about speed for us, and we can test ideas that are just simple concepts, right? So we can test concepts so much faster than I'd say the general way of doing it, which is usually you're just sitting, either you're an engineer yourself and you're changing code. I think with AI maybe it's a little bit faster now, but generally most ideas are written in code, and I think with Composer, being able to just drag and drop and think and copy and paste and really create ideas and test them fast is our edge, and to the point where I think a lot of the insights that we have as a fund come from the fact that we've looked at literally thousands of different algorithms. I've done thousands of hours just sifting through different algos on Composer because the library is so big, and really just Frankensteining and moving things back and forth, or being what if I take this type of concept and apply it to this market and this and that. I'd say the other big epiphany we had, besides just going through all these different algos and seeing what works, what doesn't, is learning how all the algorithms will work together. So our biggest thought on how we approach investing at Enders is we like to see how our algorithms all are correlated, and we like to basically build as many uncorrelated algorithms as possible. And that is the only thing we care about, is how uncorrelated are our algos at the end of the day. And the reason for that is, one, it smooths out your equity curve significantly. Two, if it gives you a chance to run algorithms that might fail in the future and not necessarily have a big effect on the rest of the portfolio. And I think we learned this mostly in the hard way. We just launched our fund in March, so we've only been live for about 5 months. And you should at least give me some ability to speak to how our fund's doing. I'm sure everyone's curious, but essentially we're outperforming the S&P by double as the end of last week. We're up 12 weeks in a row. We're looking really, really great right out of the gate. I'd say it was really nice to see our story starting to when we launched in March, which is right before the biggest dip ever. Not ever, but obviously it was a very fast dip. And I think we were telling a really great story because we had weathered that drawdown significantly. We recovered the drawdown from the March-April dip in 4 days. And I think our capital was down maybe 6% versus I think the S&P was down something 16, 17, which is what we're trying to do. Back to kind of the strategy. So what we do is we take all of our algos, we look at them, we try to figure out if they're going to be overfit or not. We can get into some examples of what that looks like. But generally, we match them, we essentially put them all in one bucket, and we say, okay, how would these all work if a portfolio is running equally weighted across all of them? And sometimes we look at different weighting types. So maybe we wait for volatility, or we look at Sharp, or we look at Acertino. It's there's a lot of different ways we can go about doing it. But we found that we like them equally weighted because we like to rebalance them pretty often, and we care about correlation, and ultimately that is the goal. I don't know if Risley you'd like to add anything there specifically to our strategy.
No, I mean, I think you hit on the major points. I think one of the core metrics that we're looking at whenever we're evaluating potentially adding a strategy to our portfolio in some way is how correlated is it, particularly in drawdown, to the other strategies that we're using. Anytime we get more than about a 1% deviation in the value of any of our strategies, we're rebalancing. So it's a way of essentially pulling money out of your winners and redistributing that risk across the portfolio. And I'm sure there's Ray Dalio fans in the audience, right, that have heard his quote that like the holy grail of investing is 10 or 15 uncorrelated return streams, and you can reduce your risk by about 80% without necessarily giving up any returns. That's really kind of, in terms of from a portfolio management perspective, I think probably the most important thing. From a strategic standpoint, I think there's a couple of things that we do, exceptionally well and better than a lot of other people do. Whether that's, when you consider the assets that you're trading, it's important to understand the characteristics of those assets. There are certain assets, for example, that we have talked about recently that you might want to, throw a standard mean reversion algorithm onto to watch, but when it's in trend, it doesn't mean revert like a lot of other assets would. Or using range-bound instruments and using those to your advantage. Just understanding the characteristics of the assets and their relationship to other things is important. Everything's kind of integrated from top down, but when push comes to shove, it's making sure we understand how uncorrelated it is so that we don't end up with too many eggs in one basket whenever we do experience volatility. And it couldn't have been a better time to launch for our story, I think, in the long term. Michael will remember that we previously turned down a webinar and told him to get back in touch with us when the VIX was under 30, which was it's because me and Moody were on the phone together for most of the day, every day. So, it was stressful in one sense, but I think coming out of that, this trusting the portfolio management and the way that we constructed it, and also, in hindsight, realizing like, wow, we navigated that exceptionally well is, really reassuring.
Well, that was actually great timing because, I think a lot of people have questions about, well, how do algorithms act when you've got a market that's acting on news as much as it was? I mean, every hour you get a new tweet and you're just like, what's going on now? But it's interesting, the algorithms still, they back test. We have models that test back to like 2003. We have some that go back to like 90s, but like generally our best models start really around 2011, mainly when like a lot of the bigger ETFs that we use today were established. I think like the algorithms really did a great job of navigating news and just, and I think news is, my theory on the news has been that it just ends up just speeding up what was already going to happen. We were already going to get a correction. We were going to get, the bottom was placed. You saw the volume spike. And then Trump, of course, tweets, and that just sends the market exactly where it was already going to go. And, we were on sides. That was like our biggest day ever. And I don't even know if we'll ever have a day that big again, because it was like, even the stock market was up, like S&P was up like 8 or 9% that day, which is nuts. But generally it was really good. I think like the other thing on strategy, so like speaking of uncorrelation, right? So the only way to do it, so like uncorrelation to me comes from a bunch of different ways. So if you hold if you look at like all the stocks in the S&P 500 and you bought the index, let's say, generally there's so much correlation between all of them. Yes, they might be there's a little bit of slight difference between sort of sectors, but I think what's great about something like Composer or building algorithms is that you can build in more uncorrelation even by trading the same assets, right? And the way I think about it is like every algorithm is a trader. So if I was a giant hedge fund and I had a floor of 100 traders, I treat the algorithms the same way. So it's like if I've got 100 algorithms all working the portfolio, some of them are going to be correlated. Some of them are going to be, S&P options traders on the floor or whatever it is, right? Or, we've got a whole department dedicated to commodities and maybe an oil desk and maybe currencies, whatever. But I think like what's interesting about the algorithms is not only are you have different algorithms maybe trading the same assets, which is going to give you uncorrelation. Because there could be two traders side by side who take entries and exits completely different than each other, and that'll actually give you uncorrelation and it'll smooth down your risk a bit. The other ways you get uncorrelation with algos is you get long and short. You get obviously different assets, and then so it's like 4 different degrees of uncorrelation. that you can create both by either trading the same assets, but also how you potentially group algorithms together. And that's something else we do is we will build out algorithms that trade other algorithms. We kind of call them like super algorithms, but it'll be in a situation where a bunch of algorithms are essentially fighting for allocation. And by, like one thing is like you put them on a sorter, that kind of thing, and we can maybe jump into some of the algorithms and stuff and what that looks like. But, just having that versus in sorting them differently versus giving them allocation based off maybe volatility will give you uncorrelation as well. And so we build our algorithms on a bunch of different markets. We've got some on tech, we've got some on different commodities, gold, emerging markets, volatility we really like is like probably the most uncorrelated. The volatility is probably the most uncorrelated algorithm that we have. And yeah, I think I'm going to show here. Let me share my screen and I'll show you some of what we can look at here. I'm probably going to start with this. This is probably one of my favorite algorithms that I've built. And what this does is I'm going to show you the performance graph first because I think it's really interesting, tells a really great story. So this has been going on since you can back to us to 2021, but essentially this only makes money on the downside. So when the S&P is moving in a downward direction and there's increased volatility, this algo actually make money. And then this is, I call this risk off KMLM and downside exposure. And this is really for the purpose of showing like what you can do with creating algorithms that relate to certain indicators and things like that. So this essentially, and this is like actually available in this specific algorithm is not available in the discovery tab, but this logic is something that you'll see often is like people using KMLM to trigger long and short and risk on and off. But essentially the logic set is that if the 14-day relative strength index of XLK, tech ETF, is greater than the 14-day relative strength index of KMLM, is a custom ETF that follows and tracks, I'd say, a basket of commodities, long and short, to create this really nice index. And it's put together by a bunch of really smart guys who've been doing this since '87, I believe. As you can find it on the website. But essentially, if tech is stronger than this, then it's a risk-on environment. For the purpose of this example, I have it in Bill, but I'm gonna actually swap it out in a second. And then if tech is actually on a 14-day relative strength index time period, if it's less than KMLM, that's when you're entering risk-off phase. So essentially, like here's the rotator that's created. I think what ends up happening is you end up buying these you buy a weighting of these stocks at 50%, and then we have a bunch of algos we've created. One trades gold, one shorts the SPY. This one's a little bit of a secret. This one is in the community. It's like a bonds algo that we found that just does really well. But essentially, those algos do really well when there's an increased volatility environment. If I swap out SPY, so you'll see that it like literally beats SPY by winning on the downside. I think it does 19% annualized. Versus SPY at 14.3 over the same time period. If I happen to put like something in here as like a risk on, so if I swap this out for SPY, you actually get an algorithm that performs at a 41% annualized return with a drawdown of 10%, which is pretty cool. Now, there's some algorithms out there that do much better than this, but this is a nice smooth equity curve, which is essentially what we're looking for. Of course, we'll actually put a lot higher alpha-seeking algorithms here, and that's like one of the algorithms that we run in our portfolio. We have like 12, we call them super algorithms that work kind of like this, that we're running currently, that are all pretty uncorrelated, that train a bunch of different assets. Here is a hedge that we run. It's called VIX on the upside and downside, but essentially all it does is try to airbag the rest of our portfolio by going long VIX in times of high volatility. And you'll actually see like on big dips, this is COVID. I forget exactly what happened here, but you see these pullbacks most recently here, on the last dip that we had. This does a great job. I mean, this is like, a free hedge. And during times of high volatility, when it moves from, 0 to 124% in like, let's say a couple of weeks, it just smooths out the drawdowns in the rest of your portfolio, something that we really like. Here's a gold algorithm I created that goes back pretty far, 2014. Does a pretty good job at beating the S&P without actually even by trading gold. Actually, it trades gold and it does better than gold If you just held GLD, you didn't do as well. But like generally, this is a great algorithm that we also have in our toolkit. There's another one here. This is called short VIXy for the long term, but essentially it shorts VIX when it makes sense to do so. Does 157% annualized since 2012, and it's been crushing, and it's crushed for a long time. The last algo I'll share, I actually have, let's see here. This is a new one I just created, and I can say like we've been running a different version of this that's been doing really well, but I just recreated this with a bunch of different logic that I really like. This one's stupid at 6,000% annualized return. Now this is the issue. I mean, you see these kind of returns. I like will not run this specific, like, and I think like the thing that people do is like they'll go look at the discovery tab and they'll see algos with this kind of return, and they'll be like, I'm gonna put all my money in that. And next thing you know, they're like down 50%, and you're like, what happened? I'm never gonna go on Composer ever again or touch an algorithm. This has a place in our portfolio. It doesn't get a lot of our allocation because it trains a lot of high volatility names. I'd say like I do like this algorithm more and more because I've been refining it for the last 6 months. But it essentially, like, we pulled a bunch of 2025 names that we thought we had a really great thesis for just having really great returns. And it probably trades about 200 different stocks. And specifically, it's holding all of these right now. And it'll essentially rotate in and out based off momentum, which stocks it thinks will run, and then it'll also capture dips on these same stocks as they dip until a certain point. And it has a similar risk on, risk off factor, similar to the algorithm I just showed you that uses some KMLM but some other moving averages as well. And you'll see like here in the when we started the year, it was in pretty risk off, and then when it felt like maybe a bottom was starting to be in place, it caught the bottom really well, and then ran really well and has been running ever since. It's down the last couple of days, but we'll see if it continues. And then that's like a good kind of like understanding. So if I take all of these different algorithms and you can either export performance and run them through ChatGPT and say how correlate, like create a correlation matrix with all these algorithms, and it'll spit out a pretty good correlation matrix that'll tell you like where you are. We also like to use, there's a tool one of the community members actually created called Maestro. So if you guys check out my Maestro, I believe .co, you can actually load a lot of Composer algorithms and see a lot of really cool stats and how they all interact together. But yeah, I think that's a good summary of kind of what we're doing. Maybe there's some more questions. Does running someone just asked this, running 12 uncorrelated algos tend to cancel out some of the returns with each other? I mean, it definitely smooths it out. We're targeting right now we're running at a 60% annualized CAGR. I'd say my personal account is tracking just that, considering that's been running for almost a year now. And we've already done, I think on my personal account we're at 42% in return, running since last September, and that's with I think 5 periods of, one, the election, and two, the big dip that we had, which is pretty good. I think we're actually going to probably try to pace between 60 and 80% annualized. I think our floor, and when we'll tell people on the fund, it's look, our floor is probably 25 to 30%. We're already at 16, 17 since March, and we think we can get there pretty easily at this size. And we're doing that with a model drawdown of 4%. If we wanted to increase our drawdown model, increase our volatility, our volatility is literally under SPY. Our volatility sits at 17%, I think. So it's interesting, right? So it's I think we're more interested in the long term. Money multiplies in compounds really fast at over 25%. So we're not really concerned with having 100% plus returns and some of the crazy stuff that you've seen out there. But generally, that's how we think about it, is we're trying to, and this is my personal money, right? So a lot of it's my own money, and I'm just all right, I only want 25 to 50% a year. I don't need to really throw myself out there and put a bunch of risk on the table and try to get, I don't really want 10% swings in my portfolio. That's the max I can personally I personally want. I want much less than that.
Yeah, I think this is an important point, and there's some related questions popping up. So I want to harp on the utility of having, uncorrelated algorithm performance in the fund or in a portfolio in general. So you do get significant risk reduction through diversification, and ultimately, like most people say, like, yes, you have to diversify in your investments, but most people don't really understand, at least mathematically, what's happening there. And unfortunately, you have a lot of people that, tout 60/40 or something like that as some sort of diverse portfolio, which it's not. But when you consider diversification with multiple long short strategies that are independently successful, independently produce returns, and then you spread your risk across those, particularly through rebalancing and making sure you're pulling money off of your winners and redistributing that risk across the portfolio, that ultimately is how you get your smoother drawdown curve. And if you want to go deep down the rabbit hole, MIT courseware has some videos that you can watch on this that can kind of dive a little bit deeper into the math of how this works. But it's not that there's no risk to diversification. If you have a strategy that live implemented gives you 100% a year returns, and then you put it with 11 other ones that only return 10% a year, like, of course you're going to give up some performance. But for us as a hedge fund, like, the primary goal here is long-term compounding growth, and compound decay is a huge issue for big money. And I think a lot of the motivation for Moody and a lot of motivation for a lot of the guys that we have with us as LPs is, like, they're not interested in seeing a 30% drawdown or a 50% drawdown in their portfolio ever, right? It doesn't matter if it's 2008. And there are smarter ways to do that than just buy and hold, and that's kind of essentially what it is that we're trying to do. There was another comment, let's see if I can find it real quick, related to this, canceling out the returns like this. So it is that each of the strategies themselves does produce returns over time. But if you take 12 uncorrelated strategies that each have a drawdown, let's say they each have a drawdown of 30 or 40%, which somebody mentioned is, like, not client viable, right? Like, nobody's interested in seeing that. But if they're truly uncorrelated to a meaningful degree and you rebalance across those, you cut your drawdown down significantly. And that's the really important thing about the way that we manage the portfolio.
Awesome. Actually, just another question from my side, like, looking at, like, some of the sign up questions. And appreciate, Moody, thanks for sharing the demonstration of the different algos there. But is there a time when you guys decide, like, here's a strategy that I want to exit now? Like, when do you guys make that decision? How does that decision get factored into, like, all the algos that you guys are running in that portfolio?
Wait, so one more time. So, like, when do we exit strategies?
Yeah, when do you decide to, like, exit a strategy or take it out of your portfolio?
So a couple of things. One is, like, I'll run a strategy, I'll pick a strategy, and I'll be like, all right, I like this strategy a lot. We'll, like, essentially forward test it, run it in, like, my personal account with, like, $1,000 or something smaller, just to be like, okay, does this do what we want it to do for, let's say, 3 months? Second thing we do is I usually tend to look at the logic, and I have a really good sense of understanding when a logic is potentially overfit versus not overfit. It's, when we're investing in Composer, and the algorithms on Composer, like, are based off higher time frames, it's a lot harder to build overfit strategies. It's still very possible to build overfit strategies, but you have to think about, like, I try to think about it from a big picture standpoint. I'm like, okay, if I'm building a gold algorithm right now, I've been literally building the same gold algorithm. That one specifically is very decent. I'm trying to build one that does a little bit better than that, but essentially, and uses maybe a little bit of, like, leveraged ETFs and things like that. So I've been trying to build that for a while, and I've been thinking about, okay, like, what are all the different things that are factors of how gold moves? And, you think about, like, macro environments, a currency, USD depreciation, that kind of thing. Also just general, like, fear in the markets, things like that. Interest rates is a big one. So it's like, I think about everything that like could factor an algorithm especially when you're trading something like gold. And I try to build those different case scenarios into it. And then I try to build backtests as far back as humanly possible. Composer's kind of restricted in terms of what that looks like based off like the life, the life starting point of the ETF. There's like some other tools out there that will give you that'll essentially simulate what some of those ETFs did tracking gold prior to that, and that'll help you. So like that's like number one is like how far of a backtest can I build? Is there every scenario kind of modeled for in the algorithm, long like a bullish case for gold, bearish case for gold, different currency risk potentially, a different environment risk, and then essentially we'll live test it. Now, if it starts to fail, so what does failing look like? We measure things like the win rate, obviously like whether or not it's even making money is probably number one. Number two is like what's its win rate going back, like on a rolling like 20-day period, for instance. If its win rate is like getting like historically becoming lower than its average, then that's a big factor in terms of determining, okay, like this algorithm may be like falling apart. Gold is probably not the best case. Like I think like some of the algorithms that we trade on like tech ETFs, things like that. I think somebody asked if we use leverage. We don't use any like margin. We use ETF leverage, if you want to call it that, like 2x ETFs, 3x ETFs occasionally, that kind of thing. So if the algorithm's losing, if its win to loss rate percentage is also losing and trending down and staying down, that's the big one for me. It's like this has been under 40% for a while. Is it the environment currently that it's trading in? Do I think that it's going to trade back up in the future under a different environment? Like that kind of thing. Like a lot of our short algos, like we don't run short algos for long periods of time. So the market's kind of designed to always go up. So we don't just have like algos that are just trying to take the market short all the time. That'd be crazy, right? So there's also like some dynamics of just understanding like traditional market sort of movement and things like that. But yeah, I think that answers the question. And then we'll shelf algos if there's algos that I know that are specifically like work on only certain markets. Like this one I just showed you that's got like a 6,000% annualized return. That only works now because it's like loaded with like high beta, up and coming, high growth stocks designed for a 2025 thesis. Like I know that's not going to work 3 years from now. I will have a new algorithm that is designed for what I think is going to pop in 26, 20, or 28, whatever it is. Those kind of algorithms, but maybe even some of the like high flying algorithms that use lots of leverage, I might put those into sorters and be like, look, like if I put them in a sorter with like maybe 20 other algorithms that are uncorrelated, or not that many, but it might be like 5 to 8, and I maybe choose the top 3. And what I'll do also in that sorter, I'll put something called a silica pack. So like think about like a pill bottle with your silica pack in there. What that does is, so like my version of that to absorb moisture, right? So like I'll put in bonds, I'll just put in SPY, TLT, I'll put in KMLM, I'll put in XL, like I'll put in like staples, but just a bunch of different like random stocks that if for some reason the algos can't even beat out the performance of those other stocks, then they won't get allocation. And that to me keeps me like is a way where I'll be able to like trade a lot of the different types of algorithms that we use without having to worry about them failing really, really hard and staying allocated to them. I know that the sorter will just figure that out for me, like a longer 60-day type of sorter. Yeah, so a lot of the times the KLM, it's not the only, I'm starting to see some of these messages, but KMLM is not the only risk on, risk off type of algorithm that I'll run, but it's definitely one of them. Because the other thing is now I have to put trust that KMLM will act accordingly for, as long as it needs to, right? So we hedge against that potential risk. Yeah, I don't know if I can talk about fund size, but like we're a smaller fund. I think we'll be at 5 million next month. And then somebody asked about what we used. We actually used Repool, which was the webinar before this. We actually introduced Composer to Repool, so that was kind of fun. But it's funny, I've got over $1 million of my personal money in different algorithms at this point, including my fund. And so yeah, like one thing I've promised investors that like my money will never come out of the fund. Obviously, like it's important to have skin in the game. Do you create actual symphonies or just? I do create a lot of my own symphonies. Discover page has a lot of great content in it. Here, let's like go through this discovery page and show you like what my process is.
So I'm going to quickly comment on a couple of these. That'll be quick while you pull it up, Moody.
Okay, go ahead.
So, we will pull inspiration from wherever we can, and Moody's about to show us why. Like, there's some really, really great ideas. Sometimes it's just one small part of a larger strategy, and you see one piece of logic, you're like, oh, that's really clever, and then you'll think about it and maybe integrate it somewhere. There's also, like, our best performing strategy for the last month or so is one that was inspiration that came from me talking to the intern at like 1 o'clock in the morning, and we were just kind of talking about a couple of ideas. And it's a symphony that is unlike anything else that's on a composer. It utilizes some data sources that are off of composer, but it's a fantastic strategy. So we'll take any inspiration or alpha generation that we can get from anywhere else. We will take it, but it's not like we're grabbing algos off of the discover page and just, okay, it's uncorrelated, let's chuck it in. One of the other questions earlier somebody asked about maybe like front running or something. What he's talking about is like we have a really rigorous process that we go to before we allocate capital to an algorithm. And there's one of the, especially when you see some of these like 10,000% annualized returns, like you don't know what your slippage is on that. You don't know if it's completely broken or completely overfit. So like the sanity check is put $1,000 in it and let it run for a couple of weeks or a couple of months and then think about it. And then we'll slowly scale that up over time as we monitor how the live performance compares to the back test. So that's one of the many ways that we are testing the algos. And we do that in small personal accounts for the first step before we start slowly allocating our clients' funds to that over time.
So I should be sharing my screen now. Let me speak to like what I'm looking around when I look at like the discovery tab. There's a lot of stuff here, right? So generally when I'm looking at building a portfolio, I want to find algorithms that are trading potentially different markets, staples and bonds boosted. I mean, that kind of catches my eye. What is that thing? Well, annualized return of 28% looks really nice since 2007, right? So this logic has been not running, but it's like this algo tests back through what? How many different financial crisis situations and just high volatility times, and it does a pretty good job. Of course, it's got a drawdown of 47%, annualized 28. It's nothing that great, but I do like that it's interesting. I might poke around and be like, what kind of logic has this been running since 2007, just to like get a core concept of like maybe there's something interesting there. I tend to, so like it's easy to just hit cumulative return and be like, oh, I want the top one, which is fine. I think you're gonna look at the same thing. It's like there might be a 50% drop. Are you okay with having a 50% drop? And when there's a 50% drop in this algorithm, are you going to look in the mirror and be like, what the hell did I just do? Is this going to ever recover? Will this continue? I mean, look, this backtest is almost 13 years old, 14 years old, and it does. It recovered really well, even through all of the Trump crisis. But essentially, that's why I'm not interested in this, because I want to know if like an algorithm's actually breaking forever, or if it's something that will actually continue and recover. And that's why we optimize our drawdown in the fund to like literally 5%. Like we don't want more than a 5% drawdown in our fund, and that's what we model for. So we expect up to 10, but generally, like our volatility and our algos work in a situation where like it's really hard to get a drawdown more than that. Of course, it can happen, but generally, like that's what we model for in our back test a lot of the times. So that's like one. There's some stuff in here, TQQ for the long-term Reddit. So this is a Reddit post that went viral by a man named Derek, who's a fantastic algo creator. But this has been, it has like the oldest out of sample date. I understand like what makes an algo good versus not, so I don't really care as much for the out of sample date as maybe some people do, because I generally know what's going to actually work or not, because I've looked at this over a few thousand hours. But this one just trades TQQ really for the most part, and it's writing TQQ right now. And it's funny, there's a lot of front runners right now that are putting people into VIX products overnight, so we'll see what happens tomorrow. But generally, this is going to keep chugging along. So that's some interesting stuff. Let's keep looking. So there's a lot of versions of this, right? All these TQQ for the long terms. And I think like what happens is people get the idea that, oh, I'm just going to like buy all of these different algorithms and hope for the best, when really they're all pretty correlated. So it's like you're kind of buying the same, like you're buying an index of the same algorithms, essentially, is what It's what's happening, and that's why it's so important to find uncorrelation in trade algorithms that are not trading necessarily the same thing. I'm seeing a lot of the same. I don't see anything that is a little bit too different. There's some emerging market ones out there. This one trades nuclear energy, which is interesting. It's probably doing really great right now. And yeah, I mean, it recovered pretty well. So there's that there. But this is another algorithm that might be nice in a sorter because it has these great longer runs before the crashes happen. And if you have uncorrelated algorithms, a lot of the times your sorter will get you out of this before this continued crash happens. And then if this continues to perform, well, then the sorter will put this back on, which is something I always like, and I use that as protection in algorithms like that.
Alex asked a good question about raising capital without verified performance history. So we do have an audited track record. The audited track record itself only goes back to September of last year. That's when it made sense in terms of having similar strategies that we were running. That's when things got really serious for us. Don't hold me to this. This is not a statement as of a final NAV print, but that account since September is up ballpark 40%. And has been performing really well. That is an audited track record, right? But also when you're starting a fund like this, your first investors, especially when you have people like Moody and myself who don't have a background in this, it's your network, it's your friends and family, it's previous business partners and stuff like that are going to be your initial seed capital. And really your only job within the first 2 or 3 years is just to establish your performance and establish your track record. And then that's, after you have that established track record that's audited and compliant, then you can start to branch out and start thinking about raising more money. Maestro's getting mentioned a bunch in the chat right now. I'm glad to see that. We know the owner of Maestro really well. We've mediated some discussions between Maestro and Composer, and there's a lot of stuff happening behind the scenes. I'll leave it at that for now. I don't know what all I can talk about.
We definitely use Maestro in some of our analysis. We've been using AI a lot too. We'll use ChatGPT. We've been using Claude. I've been trying to get into the Claude integration. I'm pretty jet lagged right now. I'm usually a little bit more energetic, but I've been in vacation for a week and a half, so now I'm getting back into it. And it's funny, watching your fund do well while you're on vacation is probably the sweetest moment. But generally, what was I saying? We started using Claude, and we're interested in how the integration goes with Composer. We have a lot of ideas for Composer and things that they could be doing to sort of beef up performance even on some of these other algorithms. We'd love to see an indicator that integrates volume a bit more. And they trust me, they get our list of ideas a lot. But yeah.
So PM has asked this question a couple times, Mood, so I'll comment on it, or something related. Essentially, there was a related question earlier about where's the money sit, right? So it's worth maybe doing a quick read on hedge fund legal structure if you're particularly interested. Essentially, there is a limited partnership that has a brokerage account that is Alpaca is the custodian, but managed by Composer. And investors. So Repool has a very clean investor dashboard. That's part of the reason we went with them, is they have done such a good job of streamlining the onboarding process and the paperwork, all the headaches that come along with onboarding a new LP to the fund. So every investor has a dashboard they can log into. Every time we NAV print, which is once a month, they can go in and see their returns. They can see the current value of their investment and all of that good stuff. It's all very clean and fantastic. So Repool is really awesome. They handle a large portion of, I think, the kind of infrastructure that you're asking about, which is calculating NAV prints, making sure we know whose money is whose and that kind of stuff within the fund at any given point in time. Yeah, so Repool is what's called a fund admin. So I would just read about that if you're curious about it. They're responsible. They have a list of responsibilities of things that they do for us, and you can watch that webinar with Kevin too. He's just a sharp son of a gun, so I'm sure it was informative.
Awesome, guys. I think we got 7 more minutes, so closing up on the hour. That went by pretty fast. I think maybe one last question to you guys. Just kind of curious about what you guys think in terms of the qualities or any key qualities that you think would make one successful in this field, in running a hedge fund and in the investment finance field?
A good business partner.
That's a great answer.
I think me and Moody would both agree that. So I don't think that either of us independently has all of the qualities we need, but I also don't think that we could complement each other more perfectly.
Yeah, no, it's a great answer. It's like your love for me, I love you too. Like I get it. Like, but generally, that's part of the answer. I think generally, like we keep an open mind. We don't think we can beat the market. We've always appreciated what algorithms can do for us. It's like we don't believe. I think human bias is on its way out in finance, and it's only a matter of time before it's all going to be algorithms that are trading everyone's portfolios, whether, and there's a little bit of like the robo-advisor now, but that's not really anything special. That's like remarketed mutual funds, in my opinion. But I think it's really just the same as any entrepreneurial spirit. The Mute 6 company I built prior to this grew to 500 people. There's 5 partners in that firm. I was third in line. I actually didn't found the company, but I helped it grow from 12 to 500 people. And our thought on this, and the partners that we have in this, we're about trying to create a really great space where people can work and develop and sort of fail. And I think like that's how we've approached it and how we're thinking about building the fund. I'd like to hire a team of 50 people as we grow in size. Our goal is to get to 100 million as quick as possible. We probably have 20 to 30 million on the sideline who are just watching us, and like specifically institutional money want to invest, but they have red tape. They can't do it until you have like at least a year track record. So it's probably sharing more than I need to share, but generally we have a lot of great things like that we're excited about. We've got a lot of great algorithms that we're testing right now that we haven't even begun to do it. If there's people out there who want to be part of it and want to get involved in some way, just add us on LinkedIn. Add me, Moody Nashawaty. I'm kind of the only one. If you want to see my life history, you can go through my name on Google and probably see it. But generally, like the thought is like we're excited about what we're doing. We want to invite other people to join us, and we think like this is the future. I'd feel really bad to be an advisor right now who isn't looking and using AI, and definitely like isn't using algorithms right now, because that's the way it's gonna be. And my portfolio is like a great sort of testament of what's possible. And I'd say like it wasn't even as optimized as it is now in terms of like what our models are. Our models only get better. You don't need a license to run a hedge fund of this size. Once you get past 100 million or 100 investors, you absolutely have to. Cool. Any other questions here? We have like 3 minutes, so I'll try to answer them rapid fire. I'm sorry if I missed all of them, but I actually been adding some of you on LinkedIn. And so if you want to reach me directly, I will literally message you while we're on the webinar. Just message me on LinkedIn and we'll become friends and talk all we want. What features did I have? I think we just need more algorithms. The way we create more uncorrelation is we need more indicators that we can build algorithms on. That's RSI, like beyond RSI, beyond moving averages. Like there's 1,000 different indicators out there. Like let's find the ones that are so different that we can bring them to the platform. Let's also look at volume. Let's figure out a way to trade intraday. That's probably our biggest gap, is trading intraday, because trading intraday is, all of our algorithms trade on a daily basis, right? At the point where we start trading intraday, then there's probably a gap that's filled in terms of like what our algorithms can do. Like if our algorithms are offsides one day and Trump decides to tweet, well, I essentially will, if it's really bad, Risley and I will have and there's a couple of us, we have to vote, but we'll actually go to cash if like our algorithms are just not in the right direction. We haven't done it. We've done it like maybe once or twice, but it's very rare we're doing anything like that. Biggest lesson learned. I mean, generally like learning how to invest in this market condition and creating like uncorrelation. So I have a lot of real estate and I'm like, all right, like it keeps me up at night. What happens to all my real estate? 2008 happens and everything dips by 50%. Like what happens to my net worth? And that keeps me up at night. So I'm like, how do I hedge against that? Well, I need to learn how to short the market in a way that makes sense. That isn't emotional, right? Like, yes, I could buy a bunch of put spreads and maybe trade it that way, but like generally it's really hard to trade down markets if you're, if you've like while it's happening, because it just kind of creeps up on you. With the algorithms, though, it creates a really great buffer for the rest of my portfolio and creates uncorrelated returns. And to the point where, like, you look at some of our models that backtest to like 2007, a lot of the money's made in times of COVID and in times of downturns because of, specifically secular bear markets move a lot faster than bull markets. We still haven't seen a secular bear market. I mean, we saw a dip in March and April. That's it. We never even stopped to return at all, right? So like that was actually quite interesting, but it wasn't secular bear market. And our models show that like in times of secular bear markets, our models will do really great. So we're excited about that. Of course, it's just the back test. We'll navigate those things day by day as it comes along. And there's never any promises in this world. But yeah, I'd say generally we're having a great time. This is like kind of the world I really wanted to be in growing up, and now I get to do it, and I get to do it with my own money, and I get to do it with like a lot of great people around me. So I'm really happy about it.
Awesome. Thanks, Moody. I think we are up on time now, a little past 7. Thank you everybody for attending. And really, really appreciate you both, your time for coming here and sharing your experience with Enders, as well as answering a lot of the questions from the community.
Absolutely.
All right, we'll wrap it up there. Stay tuned for the next webinar. Thanks, guys.